In Screencast 1.2, we're going to clean up a few loose ends that we didn't quite get around to in Screencast 1.1 of the accounting transition. In particular, we're going to take a look at the trial balance, show how you can use the trial balance to prepare the income summary, then go from the income summary to the income statement, and then finally close the income statement to the balance sheet. Another loose end was when we recorded revenues in Screencast 1.1, we did it all at once. But typically, a company like BICC would have a lot of individual, very small sales. Rather than include all these small transactions, we took a shortcut, and that is we made a summary entry at the end of the period. So instead of the individual sales, we recorded it as one summary sales. Now, of course, this isn't the way a business would actually do things, but it was just a shortcut to save us some tedium. Now, the trial balance is a useful device used by accountants for a couple of reasons. One is to prepare financial statements, and another is to check to make sure that we haven't had any errors enter along the way. So the trial balance, as you can see, we just take all of the journal entries and then add up all the debits and add up all the credits. And if we've been good and lucky, it balances. The debits equals the credits. Doesn't mean there aren't any mistakes, but at least it means that the debits equals the credits. Once we have a trial balance, then we can use this in order to prepare the income summary. The income summary is a temporary account, really a component of the owner's equity, but it really is just sort of a tool that's used in the preparation of the income statement. So we set up the T account, and then a typical use is then to scour the trial balance and determine which of these debits and credits belongs on an income statement. Well, one that we can identify right away is sales revenue. So the credit to sales revenue should increase income, and so we want to include that on our income summary. Cost of goods sold is another good candidate. It's an expense, but it's a debit, and we put that on the income summary. Rent expense, once again, another debit to income. And as you can see, the income summary provides an income statement, more or less, in the form of a T account. However, an income summary account is not an income statement, doesn't really comply with GAAP. So what we do is take the income summary and use that as a way of preparing an income statement. So we reformat the income summary into proper GAAP formatting. So in this case, we have a very simple two-step income statement. Revenue minus cost of goods sold equals gross margin. Subtract operating expenses, which in this case is only rent of $400. And you can see we now have a net income of $1,000. At this point, we're almost done with part one, but we have a few more loose ends to tie up. For one, the income summary is a temporary account, and so we want to clear its balance to zero. So this is called closing, and we want to close the income summary to the balance sheet. Since the income summary has a credit balance of $1,000, we're going to debit the income summary account for $1,000 and credit retained earnings. Transfer the $1,000 from the temporary account to the permanent retained earnings account. And once we do this, as you can see, the debit here will bring the balance of the income summary to zero. And finally, we show the balance sheet at the end of the month, and you'll notice that the income has been transferred from the income summary account to the retained earnings account. In this case, remember, the retained earnings account at the beginning of the month was zero, so the credit of $1,000 of income results in a credit of $1,000 on retained earnings. Once again, we suggest that you look at some variations